let's discuss the first topic at hand, and that is value investing. The question, of course, is that, and especially I think I would request all our viewers who have value funds in their portfolio to pay attention, because the last few years, value investing as a style, as a strategy, has not really worked. Most value funds, have underperformed the market, say for maybe a few. So what exactly is in store for 2021 and the years to come? Who should sort of buy into value funds? And the other topic that we want to talk about is also thematic funds. If we look at the last few years, and if we have to cull out some of the best performing funds, undoubtedly there'll be at least one sectoral fund, maybe a consumption fund, a pharma fund, a banking fund, that will be right on top over there. So that sort of tempts us as well to maybe consider including a thematic fund in our portfolio. So what is the suitability? Who should not? All of this will be discussed, and for that we have Saumya Shah, founder of Theraki. Saumya, thank you so much for taking our time today on the Money Show. Let's start off first with the fact that in the last 10 years we have data that suggests that 4 years we have seen value funds underperform the BSE Sensex. Why do you think this has happened? And if you could just talk to us about the basic concept of value investing as well.
Sure. Thank you so much, Mubina. It's a pleasure to be here today. To quickly kick off by just understanding the basics, value investing is investing in stocks, assets that are currently underpriced relative to their true intrinsic value. Conversely, growth investing is investing in stocks, assets that have potential for higher business growth in the future. So generally, when you look at the cycles, let's say last 20 years, 30 years, when growth stocks do well, value stocks don't, and it's the vice versa. When we look at the period of 2014 to 2019, we've seen several businesses pass through some turbulent phases where there was lack of credit, higher NPAs, 7% economic growth going down to 3 to 4%. In such scenarios, several businesses which were value picks have suffered, while investors have flocked towards growth stocks. This has also channeled most of the investments and monies towards companies that have a high future growth potential, while value picks have seen a contraction in their last 10 to 15 years average price to earnings multiple. So it's just more of on the theory of, at times we see growth stocks doing well, and then the cycle comes for value stocks. So in the last at least 5 to 7 years, we've seen an underperformance of value stocks, while growth has been doing significantly well.
Well, yeah, that's what we have witnessed, and that's why stocks as well that don't have that essentially already are extremely expensive when we look at it from price to equity perspective, have continued to rise in trade. Even though it may seem a little counterintuitive that this is a stock that has already risen so much and now it's rising even more, and this is what we've been seeing for the last few years, but now perhaps the trend may change in the year 2021. But let me just get Saumya's view on that as well. What do you think will we see in the following years? We have a lot of viewers who have value funds with them, and they've more often than not been very disappointed with what these funds have done, especially in the last 4 years. Do you think the tide will change from here on? And if yes, what makes you think so?
Absolutely. So just going by the basic principles of mean reversion, the fact that value funds have underperformed till now, at least probably for the last 1 decade, there is a significant chance for value funds to outperform in the coming years. The divergence between growth and value funds was significantly high when you look at it probably 6 months ago, but it has now significantly reduced, especially in the last 2 months. We've seen an increase in share prices of several stocks and companies in the banking space, utility space, cements. We are seeing a revival in the economy and even a revival in their stock prices, especially in the last 2 to 3 months. Investors can continue to focus on finding good quality companies, or even for that matter, good quality mutual funds at decent valuations in the value investing space. As the overall economy revives, we do expect value stocks to do well over a period of at least 2 to 4 years. based on forward-looking, I would say based on a forward-looking price to earnings and a growth potential, we can definitely expect value investing playing a critical and a crucial role in the overall growth of the portfolio of an investor.
So clearly that means that Saumya, individuals having value funds, however disappointed they are with what the fund is doing, they should stay patient. And let's say if there are individuals who've seen that, okay, this category of funds not doing well, they may have stopped their SIPs, not necessarily redeemed it, but at least stopped their SIPs. You think they should resume them at once?
So actually, like the core thesis of value investing lies around the concept of long-term investing. So if the moment you're getting into a value investing game, it has to be for a very long-term horizon. It cannot be 6 months, it cannot be 1 year, 2 years, because it's a matter of cycles between growth and value. While value fund holders have definitely seen a disappointing last decade, I would say, exiting their investments at this point does not sound like a good idea. Neither stopping their SIPs, I would say, for that matter. In the last 3 to 4 months, we've already witnessed a massive rally in several value stocks, and the NAVs of several value funds are already reflecting the same. You can pick up Nippon Value Fund, HDFC Capital Builder, L&T Value, all of these, ICICI True Value, all of these have seen a significant spike in their NAVs. So we are already seeing a revival in the value investing space. So at this point, I would definitely advise investors who are already there to stay put, like follow the basic principle, go long, go strong.
So one thing is very clear, that if you are, if you want to invest in mutual funds, and more specifically in the category of value funds, the one characteristic that you must adopt as a value fund investor is patience and a very long-term time horizon. Would you say, Saumya, that maybe the value fund category of mutual funds would also be a little riskier compared to maybe a large cap fund, or an index fund?
So yes, as a category, when you look at an overall index, it's a mix of value and growth. So you itself are getting that right amount of diversification when you put it in an index fund. When you put it in a value fund, of course, you're targeting higher returns than what an index is going to generate in the longer run. And that is why you, of course, need to be more patient as well. So, of course, there is a slightly higher risk and a very high amount of patience which is involved when you invest in a value fund. And, of course, it should not be that your portfolio should only constitute of a value fund. It should be a mix of a large cap or a multi-cap fund alongside a value fund. So probably, let's say, if you have a 20% exposure of your overall equity portfolio in a value fund, 20 to 25, that's a good number to stay with.
So away from value investing, I also want to get in your view on thematic funds, because correct me if I'm wrong, Saumya, but if we look at which are the funds with the best decadal returns, or which are the funds with the best annual return, there will be at least one thematic fund which will appear in that list. But do you think it's a good inclusion by retail investors? Because it's not that there's just one kind. There is a pharma fund, consumption fund, banking fund. So there's a plethora to choose from that as well.
Absolutely. So when you look at thematic funds, we strongly believe that investors should only invest in a thematic fund when they already have a well-diversified portfolio across different categories. Maybe a mix of flexi-cap, large cap, mid and small, or even debt funds for that matter. I personally believe that thematic funds should be the last fund in which a retail investor should participate or should get on their portfolio. And they should at least have a horizon of 7+ years when you get into the thematic investment space. The reason being, thematic investments provide an extremely low level of diversification, and those are highly concentrated bets. Retail investors with an extremely high risk appetite or a very long-term investment horizon can consider this category. But the major challenge which most of the thematic, when you look at the retail investors, the major challenge which they face in the thematic space is picking the right theme at the right time. There are already 2 or 3 thematic funds or sectors who have done very well, especially in the last 2 to 3 years. So now entering the space at an all-time high is not the ideal move which one should make. Thematic investments should generally be made when the price to earnings of the sector are low. So, and taking that right judgment call for a retail investor is a little difficult. So we strongly recommend it should actually be the last fund in your portfolio. And in today's day and age, I feel that even a flexi-cap fund is an extremely versatile and a well-suited option and a replacement for a retail investor versus a thematic fund.
Okay, and finally, Saumya, another category which we have seen not doing so well in 2021 is debt funds. What should debt fund holders brace themselves for?
So, absolutely, yes, we have seen debt fund categories, maybe liquid funds whose returns have gone down by almost 300 basis points, or short-term debt funds, or even the longer-term funds where we've seen, for especially medium to long duration funds, have also seen a drop in the NAV. This drop in the NAV is primarily attributed to the overall rise in the yields of longer duration bonds. Interest rates and bond prices have a negative correlation. In the past, when RBI reduced interest rates significantly in the last 1 year to stimulate the economy, we've seen a significant increase in the bond prices and their NAVs. But post-COVID, central banks across the globe have a major concern about inflation. And we've seen now central banks, maybe the RBI as well, who have stepped up and they're trying to control the overall stimulus. And that is leading to a drop in the bond prices. So yes, there is less volatility in the short-term space when you look at from an NAV perspective, but there's a lot of volatility in the medium to long duration funds in the fund space. So of course, if your investment horizon is 2+ years and you have that stomach to absorb the volatility, you can probably continue holding to your debt funds where you're witnessing some volatility. But of course, we have seen the returns which have fallen, and especially there will be some volatility. So again, if you're investing for the short term, make sure that the duration of the fund matches your investment duration. And if you can fathom the volatility in the longer run, then you can continue holding to your medium to long term duration funds.
All right. Okay, well, there you have it. I think that's everything to know about the different pockets of investing. Of course, we sharpened our focus a little more on value investing as well. You know what, Saumya, I request you to stay on with us. We're going to take a very short break, but be right back with your questions and queries. Ladies and gentlemen, send them to us on the Money Show at etnow.tv. We'll get right back and answer them.